Welcome back to Triple B, where we explore the fascinating intersection of emotions and financial decisions. If you've ever found yourself making impulsive choices or second-guessing your investments, you're not alone. Fear and greed, the twin forces in financial decisions when it comes to investing. Two emotions tend to take the spotlight: fear and greed. These emotions are often the driving forces behind market swings and individual investment decisions. Fear. This is especially evident during market downturns or economic uncertainty. Fear of losing money can lead to rushed decisions, like pulling out of investments too early or not investing at all. Greed. On the flip side, during periods of market growth, the fear of missing out, FOMO, can drive investors to take excessive risks. When they see others profiting, they may dive into investments without fully understanding the risks just to ride the wave of optimism. How to counteract it? To avoid the extremes of fear and greed, try to stick to a well-thought-out investment strategy that aligns with your long-term financial goals. Diversifying your portfolio and setting clear guidelines for buying and selling can help you stay disciplined during emotional market swings. Many people, especially those who have experienced a few successful investments, may fall victim to overconfidence bias. This is the tendency to overestimate one's knowledge, skills, or ability to predict the market's future movements. Overconfident investors might take on riskier investments or ignore warnings about potential market corrections because they believe their success is due to skill, rather than luck. How to counteract it? Regularly reviewing your investment strategies with a financial advisor or keeping up with market trends can help keep your ego in check. Have you ever found yourself fixating on a particular price or number when making financial decisions? For example, if you hear that a stock was once priced at $100 and is now trading at $50, you might anchor on the idea that the stock is worth $100, even though the current market value may suggest otherwise. How to counteract it? 4. Loss aversion. The fear of losing what you've gained. For example, losing $1,000 in the stock market feels much worse than gaining $1,000 feels good. This bias can cause investors to hold on to losing stocks for too long or to avoid selling investments that have decreased in value. How to counteract it? Set clear goals for each investment, including an exit strategy. 5. Mental accounting. Treating money differently based on its source. For instance, someone might splurge on a luxury item after receiving a tax refund but hesitate to spend the same amount from their regular income, even though the money is functionally equivalent. By treating money differently based on its source, people often end up spending in ways that don't align with their overall financial goals. How to counteract it? Be aware of your mental accounting habits and treat all money the same way. Whether it's a windfall or your regular paycheck, prioritize your financial goals, like paying down debt or saving for the future, before spending on non-essential items. If you found this video helpful, don't forget to like, share, and subscribe for more insights on mastering your money mindset.